In the world of trading, the concept of a gap in the market opens up interesting opportunities for traders. It's like a window of potential profit. Let me break it down for you. Imagine a scenario where there's a gap in the price movement of a stock. This gap represents a difference between the closing price of the previous day and the opening price of the next day. Now, savvy traders keep an eye on such gaps because they can signal potential trends. Here's the strategy: identify a gap and observe a stock heading towards it. The key move is to wait for the stock to break a crucial support line, typically the first horizontal support line. This breaking point triggers a sequence, and if timed right, it can lead to a rapid fill of the gap. Picture it like unlocking a door. Once that support line is breached, it's like opening the door for the gap to be filled. And that's where traders seize the opportunity to make a profit. In the dynamic world of trading, understanding and leveraging these market gaps can be a game changer for strategic and profitable moves. Gaps in the stock market are like mysteries waiting to be unraveled. They occur when a stock makes significant moves either before the market opens or after it closes. These moves are often triggered by events like earnings reports, breaking news, or some other impactful catalyst. Picture this: after such movements, when the market welcomes a new day, there's a gap between the closing price of the previous day and the opening price of the current day. It's like a void in the market, a space where no buying or selling occurred during regular trading hours. Now, when the price of a stock approaches this gap, something interesting happens. It moves swiftly through that gap. Why? Because, during market hours, there were no buyers or sellers at those levels. It's as if the market says, if there was no action here before, why would there be in the future? These gaps are like unique markers in the stock market, and understanding how price behaves around them can be a key insight for traders navigating the dynamic world of stocks. Not all gaps are created equal in the stock market. Sometimes, right before the gap begins, buyers or sellers make a stand, defending specific levels. In such cases, it's a cue for a different play, the failure to fill the gap. This strategy involves anticipating a bounce and reversal off the support line. However, here's the golden rule: patience is key. Wait for confirmation. Keep an eye on the moment when the price enters the gap. That's the sweet spot, often referred to as the long entry point, as depicted in the picture below. Remember, the market has its own language, and understanding these nuances can be the difference between a good and a great trade. The optimal point to secure profits is at the end of the gap, marked by the bottom black horizontal line above, or at the initial price level before the gap commenced. Gaps, by nature, have a significant probability of being filled, representing a healthy market movement. Studies indicate that an impressive 91.4% of gaps eventually get filled. This statistic underscores the effectiveness and potential success of employing the gap fill strategy in trading. After a stock experiences a gap, traders often observe a critical juncture to determine whether it promptly fills the gap or sustains the gap's direction. This crucial point is delineated by the black bottom line. Following the formation of the initial candle, traders may opt for the short side, strategically placing their stop loss around the opening of that first red candle. This approach aligns with capturing momentum in the market. In the image presented, the black bottom line marks the onset of the gap. Upon the price entering the gap, it often results in a shift towards the upper part of the gap. This tends to be the opportune moment for traders to secure their profits, For risk management in this strategy, it's crucial to place the stop loss below for long positions or above for short positions, aligning with the bottom black line. The determination of the risk amount is subjective and relies on the individual trader's assessment of potential gains. For traders engaging in the gap and go scenario, a gradual approach to taking profit is recommended. Once the gap is formed and sustained selling occurs, the stock often becomes overextended, limiting its potential to move much lower for technical reasons. During this phase, it's advisable to start taking profit as momentum slows down. Signs of slowing momentum may manifest as smaller candle bodies, larger wicks, or a failure to move higher at the same speed. In the gap and fill scenario, the optimal time to take profit is when the gap is successfully filled. Hope you like this video. If you have any doubts, please WhatsApp us at this number. And don't forget to subscribe to this channel. We'll upload more trading related videos here. Thank you for watching. We'll see you in the next video. Till then, take care.